The next move by the Federal Reserve is one of the most closely watched events in global financial markets. Whether it's a rate cut, a pause, or another hike, the Fed's decision can influence stocks, bonds, real estate, currencies, and even investor confidence almost instantly. For everyday investors, understanding what the Fed might do next and why is critical for making smarter investment decisions. At the center of this discussion is the Federal Reserve, the institution responsible for managing U.S. monetary policy. Its primary goals are to control inflation, support employment, and maintain financial stability. Every policy decision is a balancing act, and even small changes in direction can send powerful signals to the markets. When the Fed raises interest rates, borrowing becomes more expensive. This affects everything from corporate loans and mortgages to credit cards and business expansion. Higher rates tend to slow economic activity, which can put pressure on stock prices, especially for growth-oriented companies that rely on cheap capital to fuel expansion. If the Fed chooses to pause rates, markets often interpret it as a sign that inflation is under control or that economic growth is slowing. A pause can bring short-term relief to stocks and risk assets, but it also raises questions about what comes next. Investors begin to focus more on economic data, earnings reports, and forward guidance. A rate cut, on the other hand, usually signals concern about economic weakness. While cuts can support markets by making money cheaper, they can also indicate that the economy is facing challenges. Stocks may initially rally, but long-term performance depends on whether growth recovers or continues to slow. Bond markets are often the first to react to Fed expectations. When investors expect rates to fall, bond prices tend to rise. When higher rates are expected, bond prices usually decline. The Fed's actions also influence the U.S. dollar. Higher interest rates often strengthen the dollar by attracting global capital seeking higher yields. Real estate is another sector deeply affected by Fed policy. Interest rates directly influence mortgage rates, which impact affordability and housing demand. One of the biggest mistakes investors make is reacting emotionally to Fed announcements. Markets often move based on expectations rather than the decision itself. In conclusion, the Fed's next move matters because it shapes the cost of money, investor behavior, and market direction. Whether rates rise, pause, or fall, each scenario creates both risks and opportunities. Investors who understand these dynamics are better positioned to protect their portfolios and capture long-term growth.